Hi everyone, I just thought I'd make a brief supplementary video to the USO contango videos. I guess there's no better way to express a sentiment than to put your money where your mouth is, and that's what I've been doing. I started buying USO. I did sell some February covered calls which expired in my favour, so that helped to keep the cost down. But the upshot is that I now have a position in USO long with a cost base in the low to mid 20s. I'd also like to say that I don't have any special knowledge or opinion. I've done nothing more than walk into the same casino as everyone else and lay some money down. We'll see what happens. But I just thought people might find it interesting to have a supplementary video, particularly as it's got a more positive twist to it. Anyway, the reasons that I decided to take a long position in USO, particularly over other oil funds which have held up much better during oil's collapse, but I've gone for USO at this point. I guess that suggests that I'm thinking there's a bottom in, and I may get hammered for that, catching a falling knife. But the first reason that I decided to do that is contango is flattening, and I think that as USO has suffered so terribly with the steep contango, I think any flattening of that contango situation might just give some benefit to USO on top of other points. Point 2 is the seasonal trends that I see in oil. Buy in January and February and look to sell in the summer. That's worked for me before, and I think it may well work for me again on this occasion. Point 3. I thought oil was cheap at 50. I would have been wrong to say that it couldn't go any cheaper, because it did. But I didn't say that. I just thought it was cheap at 50, and I think it's just cheaper at 35. And the reason I'm making this point is because I actually think that some of the superpowers will agree, and there may be potential for oil hoarding if oil begins to put a bottom in that people believe in, and they see higher prices coming in the future. I mean, China, for example, have massive dollar reserves. They can't just dump them onto the market, because that would crash the dollar and affect the treasuries that they own, of which they own massive amounts. But the more I think about it, the more I think if I were China, I'd buy all the oil I could at $35 a barrel without sending the price through the roof, because it transfers dollars which they don't want into oil, which is something that they do and will certainly want in future. All the economies of the world at the moment are in collapse. We know that. It's a deflationary scenario, and there's still a lot of unwinding to come. But all the forces in the world, all the economic and political forces in the world, are working, supposedly, to get back to economic growth. Now, if they succeed, or when they succeed in that end, I do not see how we can see the world economy growing again without oil prices being dragged up from $35 or less, or wherever oil happens to bottom. I cannot imagine the world returning to 1, 2, 3% growth and not see much higher oil prices. Now, if that's the case, then some of these economies are going to want to have bought as much oil as they can at $35 rather than having to pay $70 or $80 in future. Particularly as cheap oil, and let's assume that we agree that oil at $35 and $40 is cheap, has been and is pricing alternative energy out of the market. It's certainly not viable to research new ideas in alternative energy with oil so cheap. So that in itself could become a positive for oil in the short term if oil can make a run to the upside, because the competition has been reduced. Now, I mentioned the effect of economies trying to return to growth, and one of the ways that they're trying to do this is to simply supply more and more money into the system. Now, I'm not a fan of this, and I don't think it will work in the way that they're doing it now, but they are doing it. Of course, the Federal Reserve are basically pushing on a string. They're printing all this money, the bailout money and so on and so on. They're giving it to the banks, but the banks are just hoarding it. They're not passing it on. And that means that it's not really having that great an inflationary effect yet. But there's every reason to think that it will in future. A precedent for this would be to look at Europe, and particularly the British pound, which has been in free fall. And if you look at gold and oil priced in British pounds, it's a very different scenario to the weakness we've seen in gold even, until the last week, where it's made a decent recovery, priced in dollars. Gold priced in British sterling, in British pounds, has been on a roll, because the currency's been in free fall. Now, basically what I'm saying is if we see dollar weakness, then we're going to see higher nominal oil prices too, I believe. That doesn't mean that the dollars that you make in profit are going to have any more buying power. It just means that, we're going to see better prices for oil in that scenario. Which leads me into another form of money, maybe the oldest, gold, and the gold-oil ratio, which when oil was at its peak last year, the gold-oil ratio fell to around 6, I think, where it took 6 barrels of oil. It only took 6 barrels of oil to buy an ounce of gold. Now, with the collapse of oil prices, whereas gold has held up quite well, as people have fled through fear into gold, the gold-oil ratio is now in the region of maybe 30, which I call the rubber band effect. What I mean by that is that it shot to the downside down to 6, and at that point it was overstretched. A more normal range is between 10 and 20 barrels of oil to buy an ounce of gold. But it stretched out to 6 and then shot back, and I think it's now overshot to the other side. Now, some people might say, well, okay, short gold, buy oil, and wait for the ratio to close. That's not the tack I'm going to take in these unprecedented times in which we live. I do own some gold stocks. I bought them at a good price. For example, Yamana Gold, AUY, Kinross, KGC, Silver, SLW, Silver Wheaton. And I'm going to hold on to them. I'm holding on to those gold stocks, but at the same time I've started to buy oil via USO. Because I think that gold-oil ratio may close simply by oil making a recovery of sorts. So that is, in my opinion, another thing in favour of the position that I've taken in USO. Number 7 is the point which I think would put the biggest smile on most of the long holders' faces, particularly the ones which have been suffering quite badly recently. And that is the potential for a short squeeze. The short interest in USO is very high, and of course the shorts have done very, very well on the way down. And bless them, good luck to them. I mean, I actually did make some money on the short side down, but I'm very, very shy of short selling, and I'm not the best short seller in the world. So I did make a profit, but I entered at the wrong time, and I covered far too early, so I didn't make anything like the money that I could have done. But some people have made a lot of money. The point being, you don't make a penny until you consolidate that position and turn it into a real profit. Paper profits, particularly in short selling, are meaningless. And so any potential for turnaround in oil, and particularly in USO, which is heavily shorted, could create a short squeeze. And a short squeeze is the real rocket fuel for a rally. So there is that potential too. Okay, thank you very much. Good luck to all. Bye.